Hi, I'm Peter Rose, founder of Longwood Currency Trading, and I want to take just a really brief discussion here on how to trade Forex order flow. Order flow is really the basis of what's going on in the Forex market. Not fundamentals, not technicals, none of that stuff. And so I want to take a look at that and discuss that briefly. I'm inside today. It's a beautiful day. We're in mid-May of 2024, and it's bright and sunny and warm out. Unfortunately, I don't know if you can see the bugs flying around out there. Yeah, that's a view of outside. Anyway, up here in New England, it's black fly season, and it goes from Mother's Day to Father's Day. So we've started into that, and if I was outside right now, I would be doing this with my hand all the time. I was just out. Sue took off and had an appointment down in one of the other local towns, and I'm watching her head off. I had the bow dog with me, and all I'm doing is swatting flies and bugs and stuff out of my face. So I'm inside. But it's a beautiful day. It's a wonderful day. Order flow. What is order flow? It's the economic commerce between two countries trading goods and services or whatever it is. So I'm in the United States, so if someone wants to buy tractors that we produce, they're going to have to buy them in dollars. So if you're in the Eurozone, you're not going to buy my tractor with euros. So you're going to have to sell euros and buy dollars. Then with the dollars, you can buy my tractors. That's what the currency market is all about, and that's what we call order flow. When a client goes to a major institutional trader, I'm not talking about the retail traders, you and me. We're only 5% of that $6.7 trillion a day market. It's the larger banks, JP Morgan, Chase, all those larger institutions that have clients, manufacturing clients, to call them up and say, "Hey, Billy, I need $1 billion of engine parts from this country, and so I need to sell this currency and buy that currency." So he's got $1 billion book order. That's where the money is being transferred from and to, is the interbank market. The Forex market is a distributed market, not like the New York Stock Exchange, where everybody goes to the New York Stock Exchange to buy stocks listed there, or they go to the American Exchange, or over in Germany, if you're going to buy bunds or something, you're trading there. You don't have, that's called centralized markets. We don't have a centralized market in the currency market. It's a distributed market. So you got to get your head around that. I just did a video not long ago, is the Forex market a scam? It's an interbank, international currency exchange market. It's not a scam, although there's scammy people that are involved in trying to tell you how to trade. They don't know how to do that. Their trading materials are crappy, but they're still going to hit you for a couple of $1,000, $3,000, and you're going to think that you got the secrets of the world because some dumbass taught you London Open or some Fibonacci stupid thing or whatever. It has absolutely nothing to do with how the Forex market works, or how you need to think about how the Forex market works and what causes price to move around. It's on order flow. In the course that I have a discussion of the effects of each of the pair countries, their effect that they have on the price. So price action is determined by the underlying economic stability or instability of each of those pair countries. And that's a function of the interest rate policy of their central bank. That's what affects the motivation of the customers to either buy or sell at any particular time, is the health of their country in relationship with the economic health of another country. You're going to do business with the country that gives you the best deal for their money. When your money is strong, then you're able to buy a lot of stuff. But nobody wants to buy your stuff because it costs too much. That's where the order flow, the ebb and flow between buyers and sellers come from. Nobody can fix a $6.7 trillion a day market. Nobody can scam it in there. Now, you could take a large bank and they've got a $3 billion order that they need to execute in, say, a week or 4 days or something like that. They can't just throw $3 billion against the wall because it'll completely rock the price. They won't get the price their client wants. So they have to dribble it in there. That's where you see these, the prices rising, and then there's a pullback, and then it rises again, and a pullback. The person is distributing their order into the market in an orderly fashion so that they're not paying more for one currency, and the other currency that they're trying to sell, people are still willing to sell it. So there's this balance between the buyers and the sellers, and it goes up and down like that. That's the order flow. How do you measure that order flow, or how do you use that order flow? There are two characteristic approaches to that. One is support and resistance areas or zones, and the other are trend lines. In other words, you draw level lines, horizontal lines on the chart where these congestion areas are. They're congestion areas, and they're important because that's where all this economic activity is taking place. And then when price goes on somewhere else, there's some other bank that needs something down here, and there's activity going on down here. So you get these zones of activity. So the banks that are involved in this area or this zone are playing in this area. They have to sit on the sidelines when other banks or other orders are being executed in this zone. We're talking kind of a short-term time frame here, but if you're on a 5-minute chart, you get an ATR of 5 pips. If that market is going, you could move 60, 80 bars in a row. The 5-minute chart is simply a reflection of the 1-hour chart in 5-minute chunks. So if you're trading, if you're a institutional trader, you're not looking at the 5-minute chart. You're looking at the daily and the weekly, and then for placing your trades and stuff, you may be looking at the 4-hour, because you're looking at, well, what's gone on over the last 5 days? How can I get this $3 billion out there within the 5-day period that my client has asked me to do this? So they're actively pursuing probably 4-hour chart, looking at, trying to find out where the order flow is existing currently and how they can fit their price in there. They're not saying, oh, I'm only going to pay this. You can't pay that with $3 billion or $10 billion order. You have to be willing to have a spread. This is the high and this is the low that I'm willing to pay. Those are your support and resistance trend lines for that particular group of banks that are willing to trade within that zone. And then you have another zone down here. But right now, today, this is the zone we're in. That's the order flow area that we're in. So support and resistance are not indicators. They're well, you would term them an indicator, but not like a Bollinger Band or a fib level or something stupid like that. They're indicators of order flow boundary conditions. In mathematics or physics, we call those boundary conditions. So we don't care about what's going on up here. We don't care about what's going on down there. We just care with what's going on in here, because that's where the order flow activity is going on right now. If you want to really see what's happening, you drop down onto that 5-minute chart as a day trader like I do, and I can see, well, they're willing to run that up 20 or 30 pips, but then I'm going to get a 10, 15 pip pullback because I want to pull it back close to where that I originally started at. Then they go back up another 15 or 20 pips. So that price is gradually increasing, maybe a 5 pip difference every 2 5-minute bars or 3 5-minute bars. You'll get the price has crept up 5 pips. If you do that over the course of the day or 10 hours, you get a 50 pip move, or overall move in the price. That's order flow, and that's what you need to learn how to look at. Now, there are some people that take a trending price that's going like that, and they'll draw lines like this. Those are called trend lines. If you don't know what you're doing, you're going to think that the trend line is as valid as a support resistance line, that the trend line is a support resistance line on a slope gauging an upward trend, for example. That's not the case. Trend lines are not dependable as indicators of order flow. They only indicate what happened with price at that particular time, but does not necessarily indicate that that is going to be respected at the next time. Trend lines are a lot like looking at regression to the mean events. Not mean reversion. That's a math term for a financial thing. It's regression to the mean. There are people out there that don't understand what they're talking about, but you could sort of say that if you're trying to play trend lines, you're trying to play regression to the mean events, and that becomes extremely problematic and hazardous if you don't really have a lot of experience and you don't know what you're doing, because those are totally non-predictable. It isn't so much as predictable, but from a probabilistic standpoint, your ability to trade regression to the mean or trend line events successfully is far, far, far less than if you traded order flow. That's the point of the video. First, you need to learn how to trade. Then you need to learn the characteristic of the FOREX market, which is a zero-sum game based on economic international commerce. And the price is based on the order flow of customers putting orders with large banks and the large banks trading among themselves, with 5% of that $6.7 trillion a day market being us, the retail traders. Once you understand, get the concept of order flow down, then you'll be able to look back at the market in general and all this crap that people are putting out there about fundamental analysis and technical analysis and all these tools and stuff that people are spending all this time working. Trade the order flow. That's what the banks are doing. The bank traders don't use technical analysis. The only fundamental analysis that a bank trader is going to use is what's the current interest rate policy of that country and why is it that way? Is the unemployment skewed? Do we have producer price indexing that's gone away? That's all they need to know, because that gives them a probabilistic estimate of to where interest rates are going to go. And interest rates don't change every day. The interest rate changes from a federal level, countrywide level. They might change that once every 3 months. They may have a meeting to look at the economy and say, what do we want to do with interest rates? So that's like a big ocean liner going down the road. Does the bank trader need to worry about that? Not really. He's only going to be in the market running his shit out for his client maybe for 3 or 4 or 5 days. If he's talking about maybe he's got $600 billion, maybe he's going to have to take a couple of months to do that. But once you get to look at the order flow, you say, geez, these are recurring areas of price activity. So somebody or some bodies out there are interested in doing business at this level. So price is going to come back into there at some point so these guys can transact business, because they don't want to transact it down here and they don't want to transact it down here. This is where they want to do it. Maybe the guy's producing ballpoint pens and his margins are slim. No, he's not going to produce them, because if price is not available to him to get correctly so he can buy his goods the right way, because his margins are so small that it makes a big difference. Just an eighth of a pip difference. I mean, it's $10 a pip. difference. He's interested in minuscule points of that pip out to the fifth decimal point. Because if he's selling his pen for $1.50, he can't have that price changed by $10 on his goods. Okay, so that's the order flow. That's what you have to understand. Once you understand the problem is, how does the bank trader satisfy their clients' orders? That's the problem that you have to think about. That's the problem that you're trying to solve if you're going to trade in the currency markets. If you have any questions about this stuff, throw me an email. I'll be happy to chat with you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.